A new house might be one of the most significant purchases you'll ever make. If you intend to finance the purchase, you'll need to look into mortgage options before looking for the perfect property. Not all home loans are the same, so doing your homework before deciding will help you choose the best option for your financial situation and save you money. You'll also know what to expect in terms of criteria when applying. In this video, we'll go over the basics of the various mortgage loans so you can pick the best mortgage for your family. What is a mortgage? A mortgage is a loan used to acquire a house, land, or other types of real estate. The borrower promises to repay the lender over time, usually in the form of a series of monthly payments divided into interest and principal. The property is then used as collateral for the loan. There are different types of mortgages, but for this video, we are going to examine 7 types of mortgages. Number 1. Conventional mortgage. A conventional loan is any mortgage that's not backed by the federal government. They are the most common type of mortgage. Conventional mortgages have stricter regulations on your credit score and DTI, or debt-to-income ratio. The most common type of conventional mortgage is a conforming loan. It follows Fannie Mae and Freddie Mac criteria and has loan limits that are adjusted annually to account for improvements in property values. One can buy a home with as little as 3% down payment on a conventional mortgage. You must have a minimum credit score of at least 620 to qualify. Please note, a down payment of less than 20% means you'll need to pay for PMI or private mortgage insurance. Mortgage insurance rates are usually lower for conventional loans than other types of loans, like FHA. Advantages of conventional mortgages. The overall borrowing cost after fees and interest tends to be lower than other types of mortgages. Your down payment can be as little as 3% for qualifying loans. They can be used for a primary residence, a second residence, or an investment property. Disadvantages of conventional mortgages. You must pay PMI if the down payment is less than 20%. Stringent qualifications require a minimum credit score of 620 and a low DTI. Significant documentation is needed to confirm income, assets, ability to make a down payment, and employment. Conventional mortgages are ideal for borrowers looking to put down as little as 3% with a stable income, strong credit score, and suitable employment history. Number 2. Fixed-rate mortgages. Fixed-rate mortgages have the same interest rate for the loan duration, so your monthly mortgage payment is always the same. Fixed-rate loans are normally available in terms of 15 or 30 years, while some lenders enable borrowers to choose any period between 8 and 30 years. A shorter term results in a higher monthly payment, but saves you money on interest over time. Advantages of fixed-rate loans. Payments stay the same throughout the life of the loan. Housing expenditures are easier to budget from month to month. Disadvantages of fixed-rate loans. Interest rates are initially higher than adjustable-rate mortgages, or ARMs. If interest rates fall, you'll have to refinance to take advantage of the cheaper rate. Fixed-rate loans are ideal for borrowers who prefer stable principal and interest payments on their mortgage. Number 3. Jumbo loans. A jumbo loan is a larger conventional loan that is often utilized to purchase a high-end property. Jumbo loan amounts surpass all conforming loan limits and sometimes need a substantial down payment of at least 10 to 20%. Jumbo loans differ from high-balance conforming loans because they do not follow the rules established by Fannie Mae and Freddie Mac. Jumbo loan interest rates are often comparable to conforming loan interest rates, although they are more difficult to qualify for than other loans. To qualify for a jumbo loan, you must have a higher credit score and a lower DTI. Advantages of jumbo loans. Their interest rates are comparable to those of conforming loans. You can borrow more money to purchase a more expensive property. There are adjustable and fixed rate options available. Disadvantages of jumbo loans. Typically requires a credit score of at least 700, a low DTI ratio, and significant assets. Often requires a down payment between 10% and 20%. More detailed paperwork is usually required to qualify. Jumbo loans are ideal for borrowers with an excellent credit score and a low DTI who require a loan that exceeds the conforming loan limit. A quick reminder, if you've enjoyed the video so far, consider subscribing as we frequently upload informative and educational videos. Let's continue. Number 4. FHA loans. The Federal Housing Administration, or FHA, backs these mortgage loans, which are designed for applicants with poor credit and minimal down payment cash. You can qualify for an FHA loan with a 580 credit score and a minimum 3.5% down payment. A 10% down payment is required if your credit score is between 500 and 579. Mortgage insurance is required for homeowners who put down less than 20%. In addition, unlike private mortgage insurance, you cannot cancel FHA mortgage insurance after achieving 20% equity in your property, unless you refinance into a conventional loan after achieving at least 20% equity. Advantages of FHA loans: easier to qualify for than conventional loans, relaxed credit requirements, small down payment requirements. Disadvantages of FHA loans: mortgage insurance premiums may last between 11 years and the entire term. You must live in the property. FHA loans are ideal for borrowers with low credit scores and/or those looking to put down less than 20%. Number 5. VA loans. A VA mortgage is backed by the Department of Veteran Affairs. Only qualifying military personnel, veterans, and their spouses are eligible for VA loans. In most circumstances, no down payment is required. There is no prepayment penalty and no mortgage insurance. While the VA does not have a minimum credit score requirement, VA lenders may want a credit score of at least 620. VA mortgage borrowers frequently benefit from low interest rates and minimum closing expenses. However, VA loans require a VA funding fee, which helps to keep loan costs low. Depending on your down payment and if you've previously taken out a VA-backed purchase loan, the cost ranges from 1.4% to 3.6% of the loan amount. Advantages of VA loans: relaxed credit requirements. No down payment is required for conforming loans. No mortgage insurance. Disadvantages of VA loans: only available to military members and their spouses. Must pay a VA funding fee. Must use VA-approved appraisers and, if building a custom home, VA-approved builders. VA loans are ideal for qualified military borrowers who are looking for a low interest rate and no down payment minimum. Number 6. ARMs, adjustable rate mortgage. Unlike fixed rate loans, interest rates on adjustable rate mortgages, ARMs, change with market conditions. Many ARM products feature a fixed interest rate for a few years before switching to a variable interest rate for the remaining period. For example, a 7-year, 6-month ARM indicates that your rate will remain constant for the first 7 years and then adjust every 6 months after that. When considering an ARM, it's critical to read the tiny print to understand how much your rate might rise and how much you could end up spending once the introductory term ends. Advantages of adjustable rate mortgages: during the initial period, monthly payments will be lower than with a fixed rate loan. It can help you pay much less interest over the loan life. Can save a significant amount of money on interest payments. If interest rates fall, monthly payments may decrease. Disadvantages of adjustable rate mortgages: mortgage payments may become unaffordable, resulting in a loan default. Home values may decline in a few years, making refinancing or selling more difficult before the loan resets. Unpredictable payments throughout the adjustable period might make budgeting difficult. ARMs are ideal for borrowers who don't intend to stay in their house for more than a few years. An ARM might help you save money on interest payments. However, you must be willing to accept a certain amount of risk that your payments may rise if you remain in the property. Number 7. USDA loans. USDA loans are mortgages that assist potential homeowners in purchasing properties in rural and, in some cases, suburban locations. USDA loans are backed by the United States Department of Agriculture, USDA, which indicates that the government insures or guarantees the loan. It does not mean that the loan is made by the government. It is still made by a lender. On the other hand, the USDA shields the mortgage lender from losses if you fail to repay your loan. The advantage of government backing is that you, the homeowner, will pay cheaper interest rates and make no down payment. You will, however, be required to pay closing costs. When you apply for a USDA loan, you must pay an upfront guarantee fee as well as an annual fee. The non-refundable upfront fee is normally passed on to the borrower by the lender. A USDA loan guarantee fee functions similarly to mortgage insurance for a USDA loan. The upfront guarantee fee is 1% of the loan amount. For 2023, the annual fee is 0.35% of the loan amount. Advantages of USDA loans: lower APRs, no down payment is required, and no mortgage insurance. Disadvantages of USDA loans: geographical restrictions, income limits, guarantee fee required. The home must be your primary residence. USDA loans are ideal for income-qualified borrowers in rural and some suburban areas who want a low or zero down payment. In closing, your preferences and financial situation determine the ideal mortgage loan. Once you've decided what kind of mortgage is best for you, take your time browsing around. Learn about all the costs associated with a mortgage, particularly closing costs, fees, and discount points, which you may purchase to reduce your interest rate. If you enjoyed watching this video, please like and share the video with anyone else you think could benefit from this content. Remember to hit that red subscribe button to catch our upcoming exciting topics.